Let's begin with a startling revelation. China, the second largest foreign owner of U.S. debt, recently made a move that should send alarm bells ringing in the investment community. In August, China sold over $21 billion worth of bonds. It's not just about the numbers, it's about the implications. China's decision to reduce its exposure to U.S. securities could have far-reaching consequences for the U.S. bond market. Think of it this way: when a major player like China starts selling a significant chunk of its U.S. bonds, it increases the supply of bonds in the market. This excess supply can have a cascading effect. It pushes up yields and forces bond prices down. As bond yields rise, the bond market becomes a more attractive destination for investors, and this can influence the dynamics of other investment options like stocks. China's move is an indicator of the larger global economic shift, and it's a wake-up call. Now, let's turn our attention to the heart of the matter: rising bond yields. The 10-year Treasury yield has surged to levels not seen in over 16 years, touching over 5%. If you're wondering why this is a critical issue, it's because it has the potential to affect various financial instruments and shape the investment landscape for the foreseeable future. Imagine you're an investor weighing the benefits of putting your money into stocks or bonds. Traditionally, stocks offer the potential for higher returns, but they come with a higher level of risk. On the other hand, bonds are considered a safer investment option, providing steady, albeit smaller, returns. The decision to invest in stocks or bonds is often influenced by a concept called equity risk premium. This is essentially the reward you get for taking on the additional risk associated with investing in stocks over the safer alternative of bonds. However, the key factor that determines this reward is the difference between the yield on the stock market and the yield on treasuries. With the 10-year Treasury yield soaring to levels we haven't seen in over 16 years, the risk-reward equation has significantly changed. The once sizable equity risk premium is dwindling. The yield on the S&P 500, a broad measure of the stock market, compared to the 10-year Treasury yield is now nearly at zero. In essence, this means that investors are not receiving a significant premium for investing in stocks over the less risky option of bonds. This shift in the equity risk premium has far-reaching consequences for investors like you and me. Now, let's delve into the consequences of this changing landscape. The declining equity risk premium underscores the idea that the benefit of owning stocks over bonds is diminishing. Historically, investors were willing to accept the higher risk associated with stocks because they had the potential to earn substantially more. With this premium evaporating, there's a stark choice on the horizon: invest in stocks with higher risk for minimal additional return, or opt for bonds with more security and a similar yield. The implications are profound. The equilibrium of the financial world is shifting, and the choices we make as investors will determine our financial well-being. This isn't just about numbers on a screen, it's about securing our financial future. It's about understanding that the changing dynamics of the bond and equity markets can significantly impact the returns on your investments. The prolonged bear market in bonds only adds to the complexity of the situation. This bear market is one of the most severe we've witnessed in over 250 years. With the increasing supply of bonds due to China's actions, the Federal Reserve's tapering, and fiscal policy issuances, the bond market is under immense pressure. As bond prices continue to decrease, the potential for a bond rally diminishes. So, what does all this mean for investors like you and me? It means that we must adapt to these evolving conditions. We must be vigilant, proactive, and informed. It's time to reevaluate our investment strategies and consider diversifying our portfolios. It's time to ask ourselves whether we are prepared for the changing tides in the financial world. Consider this: you're a potential homebuyer in a market where the price-to-income ratio is at a 68-year high. The cost of owning a home is becoming increasingly prohibitive. If you're an investor in stocks, especially those tech giants with soaring valuations, you're exposed to a double-edged sword. Rising bond yields have a more significant impact on technology and innovation stocks. These companies' valuations have expanded significantly this year, and much of that growth is dependent on future cash flows. As bond yields rise, the present value of those cash flows decreases, potentially affecting stock prices. Now, let's talk about a real-world example. Imagine you're considering an investment in a technology company that has been a market darling. Its valuation has skyrocketed this year. You're excited about its growth potential and the promise of high returns. But here's the twist. With the 10-year Treasury yield hitting levels not seen in over 16 years, the equity risk premium for this stock is vanishing. You're taking on more risk for the same potential reward you could get from safer investments like bonds. The once enticing promise of investing in stocks is fading. What's the way forward? It's a time for prudence and strategic thinking. As an investor, you should carefully assess your risk tolerance and re-evaluate your investment portfolio. Diversification becomes paramount. It's crucial to have a balanced mix of assets that can weather the storms of changing market conditions. Diversification doesn't mean abandoning stocks altogether, it means rethinking your approach. Consider investing in sectors less sensitive to rising interest rates. Sectors like industrial, financials, energy, and materials may offer more stability in this shifting landscape. It's also wise to monitor the volatility index, VIX, closely. When the VIX crosses certain thresholds, it's an indicator of increased market uncertainty. It's like a barometer for market sentiment, and it can help you make informed decisions. Furthermore, pay attention to the real estate market if you're considering buying a home. The elevated price-to-income ratio suggests that affordability is a growing concern. Higher mortgage rates resulting from rising bond yields can further impact your decision. It might be prudent to explore your options and be patient in a market where costs are reaching historic highs. In conclusion, the financial world is in a state of flux, and the decisions we make now will profoundly impact our financial well-being. China's bond selling, soaring bond yields, declining equity risk premiums, and the prolonged bear market in bonds are all signals of a changing financial landscape. It's time to adapt, diversify, and stay informed. Remember, it's not about making quick decisions, it's about making smart ones. It's about securing your financial future in an ever-evolving world.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.